when you're dealing with people, generally, but especially when you're dealing with people's money, they're not academics, they're not robots, right? There's emotions involved in it. So you have to be able to, I think, as an advisor, and specifically really in the world of investing, you have to be able to say, look, there's a very specific way that we're going to build a portfolio. There's there's academics here, there's statistics, it's a science. And people are people. And so you have to have a little bit of latitude. You can't be super, super rigid. That being said, there are some non-negotiables that I won't violate. Not so much for me, but for you, for the client. And you want me to hold that line. And this came about in my brain. I've been speaking now for 20 years. I've been flying around the country, going to big events. Some are small, some are big. We just had one recently in Atlanta. There were just about 1,000 people there, just under 1,000 people, the largest group I've ever spoken to. And it's fun. I like doing it. I have a good time doing it. And what's a little bit strange about that kind of a large crowd is you really need to sit in the audience and listen to what's going on, who's saying what, how is the crowd reacting, and kind of take it from there. So I don't do PowerPoint. I don't do anything like that. I don't do any real preset speech. It's just not the way I operate. And so I'm sitting in the crowd and I'm listening, and there were some dry moments, as you can probably imagine. We're talking money, we're talking taxes, we're talking insurance, we're talking stocks, all that kind of stuff. And what hit me in listening is that the advisors were asking questions of the presenters of like, well, what do you do with this? And what do you do with that? And there were a lot of these it depends answers. And that kind of gave me the topic of what I was going to talk about. So when I got up there, I spoke for about an hour and 20 minutes or so. And it just kind of in my brain, what I came up with was, look, we can talk latitude, we can talk, it depends. We can do all of that, but let's not do that. Let's talk about the non-negotiables. Let's talk about the things that have to be in order for, in my opinion, clients to be successful. And I'm specifically talking about portfolios right now. So here are the non-negotiables for me as I will behave for you, how I'll operate for you. And it's essentially one main thing broken down into 3 telltale signs as to whether or not I'm doing that. So number 1, first and foremost, I will not speculate and gamble with your money. And I will not allow you to do the same. I'm not going to facilitate it. I'm not going to say it's okay. I'm not going to say, sure, you can go gamble with a little bit of your money, and put at risk a little bit of your money. I'm not going to do that. I'm not saying that I'm better than anybody. I'm just saying there's got to be a line in the sand. And when I'm dealing with your money, which is to, the purpose of your money is to fully fund your financial plan, which holds all of your hopes and dreams and desires and legacies. It's pretty dang important. I am not going to facilitate anybody, myself or you, speculating and gambling with your money. That's a non-negotiable for me. And so what came from that, as I was speaking to the audience, is there were some great questions. And really the questions are, well, how do you determine that? Like, what does that mean? Define speculating and gambling. And that was easy. That was like throwing me a softball, because there's 3 telltale signs that I've been talking about for decades that I was taught by my mentor 15, 20 years ago. And so in no particular order, here's how you know if you are speculating or gambling with your investment money, or if your advisor is. Stock picking, track record investing, or timing the market, right? So if you're doing any of those 3 things, if you're stock picking, if you're track record investing, or if you are timing the market, then you're speculating and gambling. You don't have to be doing all 3. It could be one of them. And so when I start talking about that, of course, these advisors, because they don't necessarily have the same view, or maybe they haven't been taught the same view. It's just not something that's they've been confronted with. They were asking great follow-up questions, which honestly clients do too. And you probably might be just listening to or watching this podcast. And so, well, Joe, how is individual stock picking? How is that gambling? And what I would tell you, and I'll kind of make this abbreviated, but it's pretty clear. Like, in order to invest in a single company, so Warren Buffett and people like him have been famous for saying, only invest in things you know. And I think we've talked about this on this podcast before. People say, well, I really know fill in the blank company. I really know Apple. I've studied it. I really know it. And I would challenge people on that. So whatever stock they're thinking of, I'm like, well, okay, who is the CEO? And in Apple's case, everybody pretty much knows, Tim Cook, most people know that. Great. Okay. So you know who the CEO is. Do you know who the CFO is? And they don't. What about the COO? And they don't. How many employees do they have? And they're people will guess, but they're usually off by a factor of dozens, multiple, like 10x, 20x. What was their last quarterly free cash flow? So you could ask anything. And it's not to be a gotcha. It's just to show like how little all of us really know about any of these individual companies that we talk about that are in the news. What we know is the story. We know the marketing story. We know about Apple. We know Tesla. Tesla and Elon Musk is putting people on the moon and on Mars, and the Boring Company and SpaceX and electric. We know the story, but we don't really know the company. And so if that's the case, then you can't buy individual securities without gambling. It really is a gamble. It's not to say the gamble won't pay off. It just doesn't make a lot of sense to me to put any large amount of capital in any individual position when the point of the money is to fully fund your hopes, dreams, desires, and legacies. Like, we don't need 40 and 50 and 60% moonshot returns year over year in order to fully fund your legacy and desires. We don't. We need 6s and 7s and 8s and 9s, and those can be accomplished in a much more diversified manner by buying markets and allocating correctly. So for me, it's a non-negotiable. I'm not going to buy individual securities for my clients because I know they don't know those individual companies. And I can tell you, I don't know those individual companies. I just don't have the time or the bandwidth, nor do you, to sit down and go through the entire quarterly reports of these companies, and let alone dozens of them, in order to build a diversified portfolio. So number one, we are not going to individual stock pick. What's another sign that you're speculating and gambling, which is our non-negotiable? Well, another one would be track record investing. And, I would say that this is the one that trips people up the most, especially advisors, because they're like, whoa. All right, so let me get this straight, Joe. You're saying that we're going to build portfolios using statistics and using, math and science and to say, okay, risk premiums exist in areas like small companies over large companies and value companies over growth companies and the highly profitable versus the lower profitable and on and on and on. And I say, it's exactly what we're going to do. We're going to use those historical risk premiums in order to build a portfolio that will get you the return, the efficient return based on the risk you're willing to take. And the advisor comes back to me, and you might be thinking this too, isn't that track record investing? Joe, small company growth stocks has a track record. You're looking at it and saying, oh, it's higher than, large growth companies. And so therefore we're going to allocate more money to that. No, it's not track record investing, and this is not semantics, okay? There's a huge difference. Track record investing is not saying a certain risk premium can be demonstrated using statistical analysis, okay? That's what the academics and that's what the Nobel award-winning science is based on, statistics and beta and alpha and T-stats and all this kind of cool stuff, all this math. Track record investing is not that. Track record investing is saying, hey, this manager of this fund has beaten the market, whatever market it is that they're talking about, over the last 10 years. And so obviously he or she knows what she's doing. Look at their track record. And so we're going to allocate our money to that person. And the reason why I say that that's just another sign of speculating and gambling is the fact that somebody has beaten the market over X amount of years, an individual person, is not a good indicator of what they're going to do over the next 10 years. In other words, we don't know, we can't really disseminate whether or not that was luck or skill in that manager's ability. And what we can say is that over long periods of time, it's usually luck if somebody were to beat the market. In fact, if you tell me a manager has beaten the market over a certain period of time, a good length of time, I just kind of look at that and say, that's not good information. Good information would be you telling me who's going to beat the market in the future, which is predictive, and nobody knows the future, right? So going back to that track record investing, also the industry can really play games with that. And so if you think along these lines, follow me here. And this is what we did at the conference too. I said, look, if I take 5 people in the front row, these 5 random people, and I run an asset management firm, and I hire all 5 of these people out of some Ivy League school, and I give them each $100 million to manage, okay? And I say, this is a competition. In 5 years, one of you is going to be standing and you're going to be the winner. Well, the first person, let's say at the end of the first year, has really bad numbers. They just didn't do well. So what I do as the portfolio manager is I fire them and I take whatever money's left and I roll it up into the other four. And the bad return of that manager in that first year, I just kill that. That doesn't exist anymore. We shut down that fund, right? So those numbers don't get reported anywhere. We have four left. And we're just going to keep doing this until we wind up at the end of the year with the last person standing who happened to just win over those five people. All of the money of the other managers wound up in that person's fund, and none of those bad numbers exist anymore. Only this one person's numbers existed, right? And so then what I do is I take those numbers and I advertise them. I say, look how amazing we are at managing this person's money. It's just survivorship bias. Again, from looking at just statistics, that's known as survivorship bias. It doesn't mean that that person was actually the most amazing manager on the planet. They just happened to win, but nobody could have picked that person ahead of time. So no, we do not track record invest. We don't look at individual managers and say, oh, he or she did, XYZ better than whatever market, and therefore we're allocating money to that. No, we are looking at markets. We're looking at asset categories and how they've behaved in some cases over 100+ years. And we're saying, we don't know what's going to happen in the future, but we're going to allocate capital to those markets, to those asset categories, because they've demonstrated statistically risk premiums do pop up in those areas. Okay, so far we've said, okay, stock picking, nah, we're not going to do that. Track record investing, nah, we're not going to do that. Non-negotiable. The third one is market timing. Now, market timing can get kind of, it can sneak up on you. So an easy example of market timing is somebody to say, hey, my politician that I wanted to have win didn't win. And I think the next 4 years are going to be really, really bad. And so I'm going to pull my money out and put it in cash. And I'm going to wait until the markets drop. And then I'm going to put the money back in. And so they try to time it. And it can be politics. It can be something the Fed is doing. It could be anything. It could be any feeling that you have out there. And even if you've got data around it, you saying, I'm going to pull out of the market and then get the money back in. And I'm going to do that over and over and over and try to time when I want my capital deployed. The analytics on that are not good. The statistics tell us that timing markets doesn't work over long periods of time. Because again, we can't predict the future. So if you're going to time a market, you have to time it twice. You have to know when to get out and you have to know when to get back in, and you have to do that every time. And we've just not been able to demonstrate anybody being able to do that rather than just staying invested the whole time. That's timing the market. But here's a sneaky way of timing the market, because many of you are going to be thinking or hearing this, and you might be clients of mine too and say, oh, I would never do that. Joe's taught me so well over the last 15+ years. I'm not going to do that. Well, here's another way you're timing the market. Maybe you don't even think about it this way. I'll get a phone call or an email from a client, and they'll say, hey, the markets are dropping, because of the war in Iran. Is now a good time to put $200,000 into the market? And my question is always, well, where was the $200,000 before? Like, why didn't you put it in before? Was it sitting there waiting for this? Or does that $200,000 have a job to do? Is it supposed to be your emergency fund? Is it supposed to pay for college or the down payment on a new home? If that's the case, no, we're not going to invest it. It doesn't matter what's happening in the market. We need a long period of time to take safe money and put it at risk in order to get a return. They might say, no, I've just been sitting on the cash waiting for a good opportunity. That's timing the market. The worst thing that can happen to a gambler, by the way, whether we're track record investing or timing the market or picking individual stocks, is you actually are right once in a while. Just like when you sit at the blackjack table and you're looking at the cards and you're saying, oh man, I know I'm supposed to hit on this 16, but it just doesn't feel right. And you don't hit, and it turns out you were right. You think you have a pattern now, but you don't. Math is math. Science is science. Statistics falls in the area of statistical science and math, not speculating, not gambling. And so that's how we talked about that for about an hour and 20 minutes with these advisors. That's a non-negotiable. We will not speculate and gamble with your money. We will not facilitate it. We will not tell you it's okay for you to do it. And those are our non-negotiables.
Joe DeLisi is a registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 5280 Carroll Canyon Road, 300 San Diego, California, 92121-619-648-6400. Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. CA insurance license number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue or advise with regard to mortgages, property and casualty insurance, and/or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market interest rate, issuer credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index.
888-631-4.1. Expires 4/28.